Ranger. So today I'm going to share with you options part 1 on buy call, buy put, sell call, sell put, and what is it used for, and what's the definition of this, and some of the important things that you have to take note of while you are doing some options. So these options is just from my opinion, and everybody have a different understanding of option, definitely. Okay, so before we further carry on this video, I'd like to share with you that this video is for educational purpose only, and none of it is of any financial advice. So whatever you see the ticker symbol are just for reference only. So it's not advocating you that this stock is better, so you should try this option. No, it's not. Okay, so what is option? Option is a contract between buyer and seller. So think of it as an insurance policy for stocks. So on insurance, there's always an underwriter and there's a person who are insured, which is the buyer. And the insured person have to pay a premium to the underwriter in order for them to be covered. Okay, so that will be the contract that they are agreed for. Okay, so in any case whereby nothing happened, the underwriter, which is the one you paid for, will get the full premium. Okay, so call versus put. So what is call? Call is a right to buy, so not obligated to buy at the expiration. So buying is an options for you to claim, right? So if the buyer have a, because you pay for something, you can choose to exercise or not to exercise this call option. Okay, so put is to right to sell. It's a right to sell. So they have a right to sell, but not obligated. Okay. So what is put? Put is for people who believe that the price of the stock will goes down. Likewise for call, if I believe I believe that the stock price will go up, I will buy a call. Yeah, so on and so forth. So what's the difference between buyer and seller? So buyer has the right to exercise his call option, and seller of the call option is obligated if the buyer wants to exercise their call options or put options. Okay, so buyer pay a premium, so there's a limited losses because the losses is the premium they paid for. So unlimited gain. Later I will show you a curve, the profit and loss curve. Then you roughly understand, oh, what do I mean by unlimited gains? So the characteristic of a seller receive a premium which is paid by the buyer. So since they receive this upfront premium, it's a limited gain. That means to say, oh, this is my profit. This is my fixed profit. For example, this option contract cost the buyer $500. So after brokerage fee, we were left with 490, for example. So 490 will be the net profit for the seller to receive. As option is the same, which is a zero-sum game, the buyer gain equals to the seller loss. So since buyer have an unlimited gain, which means to say the seller has an unlimited loss. You can see the inverse in here, the opposite. Okay, so in options, we have to understand a few things. The premium you paid for. So the premium will break up into two things called intrinsic value and extrinsic value. So intrinsic value will be in the money. So what do I mean by in the money? And extrinsic value will be time value. That means to say there's no whole value. That means to say there's no exact value of this. There's no intrinsic value in here. Only just time value. No real value. Yeah, no real value. Okay, so right now I'm gonna take a look at the option premium. So down here, a few things that you have to understand, which is the time decay, data, strike, underlying price, and the DTE, which is the date to expiration. For example, down here is 0, right? So that means to say the options will expire tonight. 7 days later will be next week. 13. So 2 weeks later. So 21 days. So on and so forth. So what does it mean by in the money? So you see this blue color, blue area, blue area. This is called in the money option, in the money. So this is also in the money put option, in the money put option. So anything above or below here, above and below here. Oh yeah, this left side is call, this is put, call and put. So anything right now you see the price is 325.76, right? So anything below, that means to say anything, any strike price below this, for these call options, you are profit. You have some real value. But anything above 325.76, right? Or 325. These only have a time value. They do not have an intrinsic value. So this is all time value all the way. So you paying for a time value for things to happen, or you want to pay intrinsic value and time value for these options to play out. Okay, so in the money means that you are already in profit at the money. So 325 is at the money, so it's just nice at this money. So in options there are three terms: at the money, in the money, and out of the money. So those black area is out of the money curve or money graph. And sorry, this is money strikes. This is money strikes, moneyness strike. Because if you sell something, right, you sell above 325, definitely are profitable, right? Because if you sell high, you buy low. You sell high, 330, and if you sell low, will be 325, profit about $5. And you buy low, sell high. So for example, these are the example that you will see uh to illustrate that you are in the money or out of the money. So this is DTE, time to expiration, 7 days. So options, you have to choose the right contract, the right time, and the strike also very important. If you choose the wrong strike and you exit at the end of the expiration, most likely that you end up with zero if you choose too far away, because the chance of it happening is very low. So you want to have a balance, I want a cheap contract, and also I will have to understand that, what's the current market movement? Then I will place my contract. So first of all, understand your primary objective and what do you think of the market or what you see in the market. Okay, back to the drawing board. So now we are calculating the intrinsic value and the extrinsic value. So a simple exercise. This one, this I have done, this example I've done a few days ago. So the price might not be as actual as right now. So it's just for illustration purpose. And you can do this calculation from here. So for example, a call options underlying price is 315. Strike, just now you see this column, we go back here. Strike and underlying price. Underlying price is the price right now. Strike is what I would want to choose the price to be at expiration. Strike price. This is the price I would like to choose at expiration or near expiration. Okay, let's go back again. Strike price. Premium, $12. Intrinsic value. So you do a calculation. Just as I mentioned here, intrinsic value is the real value. Extrinsic value is only just time value. So premium minus intrinsic. So this is in the money. Okay. So from here, this example, make a quick guess. Take for about 5 seconds. What is the intrinsic value? Just a simple calculation. Yes, you are right. So it's $5. Why 5? We're just basically taking this because you buy low, which is a strike. It's 310. This is a call option, mind you. And the underlying price is $5. So technically, you have $5 worth of intrinsic value, roughly. So if the option expire right now, if straight away have a $5 intrinsic value, no matter what happened, this option worth $500. So what is extrinsic value? Which is the time value. So time value, basically just now you saw time value, which is the premium minus intrinsic value, right? Intrinsic value is 5, premium is 12. Yes, you're right. Very simple. $7. Can follow? So basically, this premium make out of two, which is intrinsic and extrinsic value. Then we look into put option. My put option is even though everything the same, right? But different direction. So you have to understand what's my objective? Where do I place my objective? Where do I see the market heading within this period of time? Then I make my decision whether I should take up this contract or not to take up this contract. So put option, underlying 315, strike 310, premium $8. So what's my intrinsic value? Make a calculated guess. And about take a few times to think about it. 3, 2, 1. Yeah, correct. It's zero, right? Easy because this is really out of the money, right? This is out of money. This is in the money. In the money. This is out of the money. So people use ITM means in the money, OTM means out of the money, ATM means at the money. So roughly, this is some of the jargon that option people would usually use to understand what kind of contract are you buying, whether are you buying the money or are you buying out of money. So this since that the intrinsic value is zero, so the extrinsic value is $8. So you're just buying the time value to make this work, as in you would like the price of the underlying price to drop below 310 and below to be profitable. That's why when you buy in the money options is usually more expensive than you buy out of money. The further you buy out of the money, the cheaper it is. So cheaper comes in probability, right? The cheaper it is, that means to say the probability of it happening is lesser. So in order to be profitable, you have to have a good balance. It can be a jackpot trade. So if the premium costs you about $1 instead of $8, that means to say that the case of it happening is very little within this period of time. It can happen. It can happen, but very little. So it suddenly become in the money, then you hit a jackpot. Maybe you hit about 800% return or 1000% return whatsoever. So the greatest fear in options or greatest enemy, we don't talk about fear. Greatest enemy in option as a buyer, which is the time decay. So every day option lose extrinsic value, the time value of money, right? Time value of money, data, right? Time decay benefit the seller but hurts the buyer. So we back to here. What I mean is that can see this data at 330. Oh, this is the pricing of the data is not updated. So because the market is closed right now. So once the market is open, the data numbers will readjust accordingly. Everything will be readjusted. All the buy and sell will be readjusted. So for simplicity, where you understand that data 0.11 means you will lose $11 every single day. So if a buyer lose $11 and 20 cents every single day, lose to who? Lose to the seller. So seller, if nothing happens, uh, seller do nothing and the price remains, the seller will collect the premium from the buyer losses of their contract. So it's a transfer. Like for example, if I'm a seller, right? Today I want to exit. Now I can exit cheaper. So I can buy back cheaper. Because I sell, for example, I sell my contract at $5, right? Then 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 right now, this contract worth $3 because of time decay. So there's a profit or loss of $2. So whose profit, whose loss? Right now, the contract was $5 and now the contract is $3. the profit will be for the seller because they sell at 5, buy at 3. So profit of $200. But likewise, the buyer of this contract bought at 5 and now it worth $3. That means to say technically you lose $200 for this buyer. So time value is the greatest enemy for buyers. So first of all, you have to be super right, and if you want a short period of time, which is the option is very cheap, and you have to be super right in order not for the options to be worthless, at the end of the day. So two things must be right: the direction and the time. Either one right, as a buyer, you will lose money. Either one wrong, you will lose money as a buyer. Okay, so for call profit and loss curve. So for example, if you buy a call at 3 to 5 and the premium you pay for is $3. So technically, if you have a strike of 3 to 5, $3 premium, break even 3 to 8. So anything above 3 to 8 at the time of expiration will be profitable. So by looking at this curve, the hockey stick curve, you see this L-shaped curve, right? This is 3 to 5. And what is this? The break-even price is 3 to 8. So how you get 3 to 8? 3 to 5, the strike, and the premium you paid for. So at least the price has to cross 3 to 8 for me to be profitable. So what if at the at expiration the price landed at 330 right here? So how much is my profit? Look to the left, between 0 to 5, which is $2, because how you get $2? 330 minus 328, which is your break-even point. So this difference, this shaded area or this area of triangle is your profit. So what if the price move to 350 or 340? 340 is easier for you to see. 340, what will be my price? Or what will be my profit? If I know 328 is my break even, 340 will be $12. Is it $12? Between 10 and 15? Yes, $12 is here. So here to here is my profit triangle. $12. $12 if equivalent to one contract is about 1,200 USD. That's for US options. So how about my loss? So my loss, if anything below 3 to 5, I get nothing. I'll lose that $300. My $3 premium. I'll lose all the premium to who? To the seller. So this is my seller profitable curve. Seller profit here. Buyer only profit here. Anything above break even. And anything below, you see down here, the buyer will lose money. Buyer lose to the seller. Okay, so down here you can see this very interesting line, right? This interesting line means this is 3 to 5, this is 3 to 6, 3 to 7, and 3 to 8. 3 to 6, right? 3 to 6. How much will the call worth? Worth an intrinsic value of $1, because you remember anything above 3 to 5, you will have the real value of the real intrinsic value, right? The intrinsic value of 3 to 6 is 1, but you pay for 3. That means to say at this price, you lose $2 because you pay for 3, you only get back $1. So you lose $2. So if you lose $2, that means to say the seller of the call option will gain $2. Likewise, $1. Buyer lose $1, seller lose the seller gain $1. So at this point, both of them don't make any money. Maybe they lose some due to the brokerage fee. Okay, so this one is pretty clear cut. So if you understand how it works, zero is here, break even is here, below here, the buyer lose money, lose to the seller. So above, this break-even is the buyer profitable curve. So likewise, if I say buyer profitable curve, it means to say the seller will lose a lot of money when it hits above 328 or 340. For example, just now I mentioned 340, buyer will gain 1002. That means to say the seller will lose 1002 to the buyer. That's all, right? Quite simple, quite straightforward. So right now, put profit and loss curve. So for example, you buy a put at 325, premium of $4, break even 321. Below this will be the buyer of the put option profit. 325, $4 or $4 premium. $4 premium. This is your premium you paid for. So this is your break even. Break even is 321. 321 and below you'll be profitable. You have to factor in your premium you paid for at expiration. This only talking about expiration curve. So there's another different type of curve which is before expiration. There's some time value which is the extrinsic value. So the calculation will be slightly different, but the understanding of the matter is the same. Okay, so this is 325, 321. So at closing price at expiration, the price closed at 320. How much is my max profit? So from here you to look into the left side, you'll see this value is from 0 to 5, and this just nice land at 1. So I will gain $1 profit from here if the price lands at 320. So let's see when it lands at 310, it will be $11. So is it very similar to whatever you see on the call side, but just on the flip side? Never mind if you don't change so fast, as in you cannot uh digest these two curves right now. But over time, after a few entry of options, you're like, oh, okay, it makes sense right here. Because right now I open up your awareness about the how the buy put and buy call um profit profit and loss curve looks like. So after that you slowly explore and you understand, oh, it actually makes sense after some practical. Okay, so here is $11. As I mentioned, down here this line will be um if the price move 326, the buyer will lose $3 because the premium $4. So this is $1 gain, $3 and $1. Sorry, the buyer will lose $3 and the seller will gain $3. So this is the zero sum game. Anything below, the buyer lose money. Anything above, the seller lose a lot of money. So this is the break even. 3, 2, 1. Yeah. Take a time, digest it. It's okay that you don't get it at first try. Definitely that you will get it along the way after some practical and after reviewing your actions. And revisit the video if you have to. So since then, that you see that the curve of the profit curve for the seller, right? The seller of this option, call option and the put option, right? It's not in their favor. Then why people would want to do such strategy? So when you want to sell options, right? You also have to think about your objective. What do you want? And also have to talk about your risk. You do not want to over leverage. You have to know that what are you doing? You have to understand what's your objective. So there's a few strategy catered can be used in conjunction with options. Like for example, cover call strategy. So some people use it as an income trade. Best will be used for ranging situation or yeah, ranging will be nice to use for cover call strategy to have an income trade. But when times like when the stock move very violently upside, covered call strategy maybe might not be a very good strategy. You might miss a very big move if it's a very strong breakout. So try to make it like a range strategy for your income trade, unless you want to exit your stock. Unless you want to exit your stocks, then you can do what you need to do. So what is covered call strategy? If you own 100 shares and to sell, this is to primarily you have to own 100 shares and sell a call above the market price. A call as in one contract. Since one in US market, one contract for this is 100 share. So you have to have 100 share, then you sell 100 share at the price above the price, right? So what will you gain? First of all, you gain a premium. So if the price move above, you will sell your stocks away. So you sell a stock plus the premium. It can be like a take profit for some people. And this is 100 share per contract. So if it doesn't close above, then you collect the full premium. So it become an income trade. Income trade, that means to say, oh, you can pay out like this certain amount of percentage every time. I'm okay to hold, I'm okay to sell. That's your mindset. I'm okay to sell away if the price close above this this strike price. Then I will execute this. If you're not comfortable, you say, what if it close above, then I want to hold this to, some people want to hold something for to the moon, or that the momentum is very strong, then don't do this, because you'll lose out a lot, whereby uh you might want to do a partial exit instead of this 100 share call or sell covered call. Yeah. So it really depends on what you see from the market. If you see this as a range, I think this might be a very good strategy. Yep. Okay. So next we move to cash secure put. Cash secure put, that means to say if you want to sell 100 or one contract, you make sure that you have this amount of money as cash in your account. So anything that you don't have, right, will be considered as leverage. And if the price crashes way below, right, then that will be an issue with your whole entire account. It might get liquidated if you are selling too many put or too many call options. So you have to be very careful. You have to really manage your risk very well in options. Not careful, you lose quite a painful sum of your money, hard-earned money. Okay, so when we look into this, you sell a put that you at the price that you wanted to buy. So why don't you want to buy the stock straight at the price that you want? It's just a pending order. You can definitely. So some people just want to gain some interest or gain some premium along the way while waiting for it to happen, right? So and let the time decay work in your favor. That means to say, okay, you about just now you saw Tesla is about 0.112, right? Which is $11.20. Want this contract to pay you $11.20 every single day if the price doesn't move. But if the price drop below this amount of strike price that I agree to buy, then it's fine. I get a sign. Either way, I win. That should be the mindset. So this mindset, right, is only good if you are buying a stock that you also can walk away. Meaning to say, you don't mind to miss this stock price. Uh, they just want to make an income trade. If I were to hold, I'm okay. I no need to I must have this in my portfolio. I think that this will go parabolic or whatever, this I can see this future. Then I need to adjust adjust my contract accordingly and increase my stock position to instead of selling too much put, I will sell lesser put, I will buy more actual stocks. Yeah. To keep the premium, get the stock at discount. This is the main objective. Buying 100 share. So, for example, um, the strike is 320, the premium is $5. So technically, I only need I'm buying this stock at 315. So I save $500 from buying this 320. Even though it appears 320 in your screen if you get assigned, but ideally, right, or technically, right, you only paid 315, which is $31,500. 500 premium is already credited to your account. Yeah. So the same. So if the price only goes to 312, you didn't hit 320 or below, then you collect the full value of premium, which is $500, but you do not get any share. You do not get any share. You didn't get assigned. So for stocks like this, just now I mentioned, if you really like the stock, I will not recommend you to do it fully, or you want to allocate 1,000 share to buy this stock, then you will not sell 10 contracts straight away. That will be a bit risky. Risky to a certain extent whereby what if it doesn't hit? What if it drop a lot faster? So I will spread my buy a little bit, like maybe 20% set cash secure put, the rest I will buy in as stocks. I'll put a pending order. So I will not have this scenario. I just collect the premium but I don't get assigned. For stocks that I really want it badly, then I will do like 10%, 20%, or 30%, depends on your comfort level. Yeah. So scaling slowly, take your time, it's okay. So that's all about cash secure put and covered call. And you have to first of all understand your objective, what is in your mind, what would you want to plan. So use this to execute as your plan, not the another way around. Okay, so selling option strategy. What's the action? Sell call, sell put. So it's covered call and cash secure put. Selling shares, and this is for accumulating shares. So take profit if close above the strike price plus premium, else collect premium only. Yeah. So buy shares at the strike price with the discount from premium collected, else collect premium only. You understand? So one is get assigned, one is don't get assigned. So one is get assigned and one doesn't get assigned. Doesn't get assigned, you collect full premium. You get assigned, that means to say you have to sell your share, or you have to buy the share at the strike price, that you already put in. So regardless of your underlying anymore, if the underlying drop until $300, you still buy your Tesla stock at 320. Regardless, this is your strike price. It's not about your underlying price anymore. So your underlying price drop below the strike price, then will get assigned. So if the Tesla price crashes all the way until $200, you have to still buy at 320 because this is a strike price that you have entered for the contract. So that is the unlimited downside, the potential, loss. Straight away now, Tesla $200, but my contract is at 320. There will be $120 difference of 100 shares, which is $12,000. Yeah. So option objective summary. First of all, understand your objective. What do you see from the market? When do you use a buy call? When do you use a buy put? Sell call? Sell put. If a profit, you only profit if the stock goes up, and the profit if the stock goes down, limited to premium paid. Of it. Unlimited upside, limited downside for put because the lowest price you can go for a stock is zero. So anything you short to zero is that is your limit. Right now, the price to zero. Call, the sky is the limit, right? There's no ceiling for the price upwards. So when do you use it? When you have a strong upside movement, a strong downside movement that you believe that the momentum is here, or will do a quick bounce or a very strong bounce, then you will use this to your advantage. Sell call. Earn premium if the stock stays below the strike. Likewise for sell put, earn premiums or buy stock at discount. Yeah, so this also sell when it's above. And unlimited, if stock rise sharply, so unlimited losses, cross above, that's your loss. Because this down here, right, doesn't have any sales. If it get executed, then it will be a negative sign. That means to say you are short selling your stock. So sell put, significant if stock drops sharply. So I mentioned scenario 320 drop to 3200, like this kind of adverse situation. Then you have to buy your stock at 320, not $200 anymore at that today's price. So what's the reward? Limited to premium receive. So this is the receive of premium. Then unlimited losses. If you don't close it early or you'll just wait for it to expire, then there will be a very, very, very big dent to your account size. Limited to premium receive. So likewise for the call and put, it's the same. So when will I use it? It will be more towards a neutral or downside. I foresee there a downside movement, then I will sell a call. So if I will see upside movement, I will sell a put, but not so strong. Not so strong. I feel like okay, this is good, and the premiums spike up due to some scenario. So the IV, or later part we'll talk about IV and other things that we look into apart from here. The volatility, the delta, and how will you do your options and how do you reduce risk if you don't just go for uh, buy call and buy put, just straight call, straight put. What else you can do? Okay, so summary. Before you carry on with any options, please understand your objective by using these options. Is it for speculation or is it for income trade? So buyer need to know the direction and timely, roughly right. So the BTE closer to the closer DTE, right? Then means to say that you have to be right even more. You have to be even more accurate. The smaller the time frame, the bigger the time, they have some margin of error for you to move around before the price move into your direction. Yeah. Then the seller just earn from the time decay. So this is all that you need to know for options. So lastly, this is my channel. Like, subscribe, and comment your questions. Follow for more option strategy, and hope that you understand all this strategy I shared with you just now. And if you find it useful, please send it to a friend that you think that it can help them a lot in their trading journey.